Hello, and thank you for joining for yet another live event. I want to start with a deal that looks disciplined on paper. The rent growth is modest, the reserves are funded, the sponsor did not stretch on the purchase price, and then you find the assumptions sitting underneath all of it. The refinance in year three depends on rates being lower than they are today, not the business plan, the financing. The whole thing is resting on a rate cut that may or may not arrive. This is the pressure point I want to work through with you today. But before we dive in, for those who may be tuning in for the first time, my name is Vesi Kapulian. I spent most of my career in underwriting and risk management. I'm also a real estate investor, and I've sat on three sides of the capital table: the lender side, the investor side, and now where I spend most of my time is advising families, family enterprises, their family offices on strategic investments, due diligence, risk management, and governance. And that's the third side of the table I've been sitting at. So, capital preservation and downside risk, opportunity and upside, and then preserving the wealth across generation. But without further ado, I want to dive into today's topic, which was actually inspired by a recent article. A few weeks ago, Rabil, the CEO of Kayne Anderson, sat down with Bloomberg and did something that I personally respect. He refused to give a short-term rate prediction. Instead, he laid out a stance worth paying attention to: higher for longer right now, lower eventually, maybe over a long horizon. And in his view, the crucial lesson for anyone deploying capital is that the deal has to work at today's cost of capital. Repeat, the deal has to work at today's cost of capital. Any eventual easing is a bonus and not necessarily foundation for the investment case that you may be making as you allocate capital. And I want you to sit with that phrase for a minute. This is again a bonus, not the foundation, because most of the risk I see does not come from people being wrong about where rates are going, but rather from people being right about the direction and wrong about the timing, and building the deal as if the two were the same thing. And so let me take a step back for a moment and separate these two, because it's a subtle nuance but an important one. This is the structural story, and then there is the cyclical story, and they operate on different schedules, different clocks, if you will. So Rabil's structural story is disinflation. He points to two forces. On the one hand, you have artificial intelligence, which he treats not as a buzzword necessarily, but as a real efficiency engine that pushes costs down across a variety of industries over time. And then you also have the demographics, an aging population where spending shifts predominantly towards healthcare and services rather than the broad, fast-paced growth you get from a young, rapidly expanding workforce. And directionally, that map points towards lower borrowing costs over the long run. I personally find it persuasive as a background condition. But here is where I want you to pay attention to, and where I part ways with how a lot of people use a thesis like this. A background condition is not necessarily a schedule or confirmed timing. The structural forces that I just mentioned tell you the general slope of where perhaps rates may be heading, the general slope of the terrain, if you will. But they do not tell you what the curve does over the specific 3 year or 5 year hold during which you have that investment. And the loan matures on that schedule, right? The exit is planned around that schedule, not on the general thesis of where rates may be over the long-term horizon. So in this case, the question is not necessarily whether Rabil is right about disinflation, but rather how does your deal perform? What breaks in your deal if he's right about the direction, but your timing is off, which is exactly what he basically was implying. And so let me be more specific because this is where it stops being macro commentary and starts being underwriting. And again, macro is important to understand, but we underwrite the deal based on today and based on a defined time horizon. So if you finance to a future rate, three things happen. You pay more on entry because you can justify it. You size more leverage because the exit math looks better on paper. And you carry the refinance risk that only shows up when the cushion is gone. And now compare that to how Rabil describes the discipline inside his own firms. Deals are structured so that higher base rates do not break them. Spreads and margins have to be wide enough to absorb rate volatility, and refinance risk gets analyzed under a scenario where the curve flattens but does not collapse. And the investor communication in that regard is explicit. The strategy is not built on chasing the next rate pivot. And that last pattern really matters, and it matters more than it sounds on the surface, because it is not just an underwriting choice, but it is what you are projecting for investors or investing partners, the people whose capital that you hold. There was one detail also in their interview that I keep coming back to, and Rabil noted that a meaningful slice of recent job growth came from local government rather than the broad private sector expansion. And I'm not necessarily bringing that up to make a labor market call, but I am bringing it up because of what it tells you about reading the data under pressure, right? The headline number and the underlying data are two different things. If the growth is narrower than the top line suggests, the inflation impulse that would force rates sharply higher may be softer than the market fears, and the economy can, in his words, hang out at these levels actually for a while. And this is the same discipline applied to a jobs report that you should be applying to your own rent roll. Do not underwrite the headline, but underwrite the underlying trends, the engine, if you will. And so let me bring this back to the decision that you may be facing if you are evaluating a deal like that. The disinflationary forces are real, and they do influence rates, but more than rates. They shape the spending patterns, they shape where employment actually comes from, they shape which assets hold demand when money gets more expensive. And those are worth studying, but none of that earns a place in your base case as a timing assumption. Structural forces belong in the background, they're important to understand, but today's cost of capital is what belongs in the model. So if your deal only works because the curves moves in your favor, you don't really have a deal. You have a forecast with a mortgage attached and a not so pleasant surprise coming up in 3 years. And so the question I want to leave you with is a simple one, and I will ask it of every deal on your desk this quarter. Strip out any assumed refinance relief. And by the way, I see many of those these days. Strip out every basis point of it and ask yourself, does the deal still stand on its own cash flow, its own reserve, and its own margin of error? And if the answer is yes, then any eventual easing is really an upside, a bonus point. However, if the answer is no, then the rate cut was never your upside, it was the foundation of the deal. And let me tell you, it's a shaky one. It's not a foundation you can stand on. And so, share in the comments below. I'd like to hear how you're thinking about it when you are underwriting right now. Do you treat lower rates as a possibility, or do you bake it in your business plan? I love a healthy discussion, so happy to see a differing opinion. And tell me in the comments. I'd love to keep the conversation going. As a side note, I cover due diligence and deal analysis in my book, Mastering Multifamily Underwriting, and a more balanced look on passive investing in my latest book, The Busy Professional's Guide to Passive Apartment Investing. Both became Amazon bestsellers, and the launch pricing for my latest book actually expires on August 11th, so I will post the link in the comments so you can grab your copy while the launch pricing is in effect. I also write about due diligence and underwriting in my newsletter, The Underwriting Minute, where I break multifamily underwriting one step at a time. And if this way of thinking is useful to you, that is where the longer version of those snippets live. So you're welcome to subscribe and enjoy that complimentary content. Otherwise, I pop in once a week to do these lives inspired by questions from you, recent events, comments from you. So I appreciate your engagement. I appreciate you, and thank you for spending part of your afternoon with me. Ciao.